Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Manesh. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Silicon Valley. Welcome to the show, Neal Bawa.
Thanks for having me on, Victor. Very excited to be on the Espresso Podcast.
Great to have you here. Neal, we've got to know each other and we've been looking at all kinds of different projects over the span of the last year. And I'd love to get your perspective for our listeners. You've got a fairly sizable portfolio. What's been happening in the capital markets? I know there's been a lot of movement in the last 60 to 90 days, and love to get your perspective on what's working, what's not working, and what's the current landscape.
I think we're currently in the part of the cycle where the capital markets are still trying to figure out where they want to be at. And so the first thing that we're seeing in the capital markets is inconsistency across the board. There's lenders that are behaving completely different from how they should be behaving. There's lenders that are driven by fear, not by data. This happens very early in a event like this. We saw it happen very briefly after 2000 and after the 9/11 event. And so certain parts of the market have frozen up completely simply because they don't know how to underwrite. So we are seeing CMBS loans pretty much being locked out of the market at this point. Most of the insurance lenders, who were really a phenomenal source of lending, especially for those of us that are in multifamily, are just sitting on the sidelines. I mean, I think these people have a huge amount of dry powder to deploy. They just don't have a methodology that works for them. They're worried about, asset prices going down. They're worried about potential defaults. They're worried about tenants not paying, nationwide rent strikes, whatever you want to call it. It's led these people to, at this point, just say, hey, we're just going to sit out of the market for the next 2 or 3 months and see what happens, which basically means that if you're looking at the capital markets and you have a project today, if it's obviously things depend upon whether it's a value add project or if it's new construction, but the number of players has reduced to, there's Fannie Mae, there's Freddie Mac, there's local banks. And the biggest variation that I'm seeing is in the local banks. We've got some banks, like some of our projects are still being quoted. They're quoting lower rates than they were quoting, in February, simply because you're seeing, 10-year treasuries down this much, which is puzzling to us because in my mind, those rates should be higher now because the risk levels are higher. But those banks haven't adjusted. So we've talked with local banks for a project in Dallas. We've talked with local banks for a project in Phoenix and one in Utah. And those banks are actually quoting lower numbers now. But there's a big but there. Those banks are making sure that the liquidity amongst the general partners is higher. They're making sure that the net worth numbers are higher. Before, they were a little bit flexible on that. So $20 million loans, if the net worth for the partners was $15 million, it sort of worked. If the liquidity wasn't 5%, it still worked. Today, not only do they want that liquidity and they want 10% liquidity instead of 5% liquidity, but they're being a lot more careful about who it is that's actually putting liquidity into the project. There was this process where everyone was bringing these piggyback balance sheet people into the project where it's really Neal's project or Victor's project, and then you bring one other person in just to kind of shore up the balance sheet. The banks are not looking at that as something that they like today. So there are loans being turned down because 95% of the balance sheet, the liquidity, the net worth is coming from some third party that clearly had nothing to do with the project. And that's not being allowed anymore. And that's making it really difficult for folks that are looking to buy, value add projects. So that, that's what we're seeing on the capital market side. And then on the Fannie and Freddie side, of course, we've heard about this, where Fannie and Freddie are like, well, we don't know if you're going to be able to pay your mortgage. So what we're going to do is ask you to pay a year's worth of your insurance, a year's worth of your mortgage, a year's worth of taxes. We want you to impound all of those taxes together and give it to us up front when you're buying your value add property. And then, and this part is not 100% clear, we're going to basically allow you to draw from that. Now, initially the guidance was, no, you still have to pay us. We're not going to let you draw from it. And then they started saying, yeah, there are some cases where you could actually draw from that money and not pay your mortgage. So now we have the syndication industry, which is like, wow, so all of a sudden for a $20 million property, I have to raise 1.5 million more. And what happens a year later? I mean, when I pay this, when these impounds go away, but now I've raised 1.5 million in equity. Oh my God, I have to pay a lot less for the property. So people are still at that point where they haven't figured out there are intermediate financial engineering solutions, and I can discuss one of the solutions with you. And so a lot of people are now preparing to raise 1.5 million extra in equity, and that is inevitably going to drive up cap rates because you're going to end up paying quite a lot less for that building if you're raising $1 million more in equity, because your returns are going to go down, right? What people should be doing is short-term financial engineering, but I haven't seen a lot of people try that, so they're just raising extra equity. So as a result, the market is freezing up, and a lot of this has to do with non-availability of capital, because our initial fear of delinquency, our initial fear of decline in occupancy, clearly we're beginning to get past that. Would you agree with that, Victor, that we're beginning to get past that?
Well, I guess it really depends on a number of things because this is such a moving target from week to week.
Mm-hmm.
One of the things lenders and investors alike have been looking at is what's the collections going to look like? What was the default rate going to be for tenants on April 1st and on May 1st? I know the numbers are just starting to come in for the 1st of May. What's been your perspective in your portfolio? How have those collections gone?
Much better than expected for both April and May. So we were at about 92% in collections for April. May we were projecting would be a little worse, like 2% worse. So we were thinking we'd come in at 90. So far, May, every single property that has been pulled in the first 12 days of the month is a little bit above. I can speculate as to why that's happening. I think it's probably the more of the checks coming in. It's the very generous unemployment program that we have going right now. So it could be one of those. It could be the fact that because PPP checks have come into employers, a lot of them are like, okay, come on back in. So I think it's a combination of those. So we're actually seeing an uptick from where we were in April. And to be honest, I thought that we were really happy with April because we were, there was this 45 days ago, there was this gloom doom scenario where 30% of your tenants wouldn't pay rent or 20% wouldn't pay rent. Well, if you're collecting over 90%, and that's, by the way, also a nationwide number, our properties didn't do anything extraordinary. We were in that 91, 92% collection range. Class B properties are collecting maybe another percent more, and Class A are collecting even another 2% more. But on the occupancy side, it's been very, very stable. I've checked with all of my friends. Everyone says occupancy is stable. A lot of people that had given us notices to vacate have decided to pull those notices back. They don't want to go anywhere in the middle of a pandemic. We are seeing a significant dip in occupancy for Class A properties, and that happened in May only, not in April, so we didn't see anything there. But in May, it was sharp enough for multiple sources to talk about it and for us to look at it, and it's like, oh yeah, we're getting advisories from Marcus and Millistrap and Barcadia and a bunch of other people saying, you know what, there's an occupancy issue beginning to happen in Class A. So we've seen that, but it hasn't affected Class B or Class C as yet. Rents have been mostly flat, so down 0.7% for so far because of this, and that's a very, very small decline in rents. But I do expect that there's going to be some more decline in rents going forward. And the lenders, really, the reason the capital markets are frozen is they want to see this stuff. They want to see where rents go, where occupancies go, where delinquencies go. And as we move forward, there's the potential that the capital markets will loosen, because we certainly are not seeing any evidence of doom gloom scenarios. We're not seeing anything worst case happen anywhere in the country.
Well, it's a human reaction. It doesn't matter whether you're an investor or not. People like certainty, and investors in particular like certainty. And my goodness, we are certainly in a period of uncertainty. So how do you give an investor certainty when things are moving so quickly from week to week? You're going to be standing in front of an investor and saying, oh, don't worry about those 33 million unemployment claims. That's not going to affect our rental business at all. And they're going to look at you a little bit skeptically. Do you sit on the sidelines now? Do you try and move forward with projects, or do you only go after distressed assets? What's your perspective?
I think my mindset on that changes on a day-to-day basis. As I look at data, it changes. I believe that my thought process of how much distressed assets they're going to be in the, let's say, the multifamily realm, which I tend to be focused on, or public storage, I think there's going to be less distressed assets than I thought 30 days ago. And that may still change. It really depends on how we do with the reopening of the country and whether we see, subsequent shutdowns. But today, what I'm seeing is small rent declines, significant price declines because of the Fannie Mae Freddie Mac impound restrictions. So it could be as much as 10% of a price decline that we could see in Q3 and Q4. But my investment philosophy and thesis has always been about 5 years. And I believe that within 24 months, we're going to come back close to, not exactly where we are, but close to where we were at the beginning of the year. So it could be 24 months, could be 30, it could even be 36 months. But there is no statistical evidence of a 1930s type depression scenario. I think that would have happened if we hadn't shut the country down and ended up with millions of people that have died and hospitals that were bankrupt. We are still going to see problems. We're going to see problems in the hospital sector, in tourism. We're going to see problems in real estate sectors that are tied to that. So malls and hotels are going to definitely see issues. But my investment thesis has always been, I'm buying buildings because I still think that people need to pay rent. And I think it was proven right in a way that we've never seen before, Victor. We had tenants who had lost their jobs that paid rent for April and May, which just gives you this belief that you're in the right segment. I mean, and everybody else, all of my friends that are in other segments in real estate, every time I talk with them, they're like, "Oh boy, Neal, you're so lucky. You're in apartments and I'm doing this and I'm in strip malls and I'm in hotels." I mean, you can hear in their voice that's where they want to be. They want to be in the workforce apartment housing business. So I do believe that we're going to see some price declines, but I think that those price declines may be fairly short. You might see them in Q3 and Q4 of this year, and the market might then restabilize. I also believe that by the beginning of the year, Fannie Mae and Freddie Mac will withdraw these highly onerous and unnecessary restrictions regarding impounds, because that's really what's driving the multifamily market down. It is not rents. It is not occupancy. It is not delinquency. What's driving the market down is the Fannie Mae, Freddie Mac onerous requirement. And I think they're going to realize that and pull back on it.
Well, Neal, I love it. Thank you for this perspective. I think it's a tremendous insight. Will you come back and chat with us again, talk about maybe some other aspects of the market?
I'd love to do that, Victor.
Well, if folks want to get in touch, if they want to learn a bit more, what's the best way?
Multifamilyu.com. That's multifamily followed by the letter u.com. We do about 50 webinars a year and have about 40,000 attendees a year that attend our various information-driven webinars. They're about all aspects of real estate, all assets in real estate. So I'd love to talk with you through multifamilyU.com.
That's awesome. Well, definitely reach out to Neal at multifamilyU.com. And for the listeners at home, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.